So we left off here, and we're going to go forward and talk about the different kinds of equity and how they work. So the first kind of equity we're going to talk about is common stock. So common stock is the most common kind of equity, and common stockholders are the people who actually own the company. So when we get equity investment from common stockholders, they are the company's owners. And from the company's standpoint, there's absolutely no requirement to ever pay back invested funds to common stockholders. This is what's called permanent capital. So when you invest in a company, there's no guarantee that you'll ever get your money back from the company. You can sell your investment to some other investor. That doesn't affect the company. So if I buy IBM stock and then I sell it 2 years later to somebody else, IBM really doesn't have any effect on IBM. They don't care who their shareholders are, just that they have that equity investment. And it is the most important capital base, and companies can use that capital base to leverage borrowed funds. So if you have capital, then other lenders may be willing to lend you. If you have no equity capital, it's really hard to get loans because there's no basis for the loans to be made on. Debt, on the other hand, has to be repaid. So debt has to be repaid and generally has to be repaid with interest. So, excuse me, I guess it must be, it's not, I don't know why I'm yawning, but whatever. So debt has to be repaid, so it's a different kind of capital. It's money that has to be paid back. It generally has to be paid back with interest. If a company can invest the loans that they take at a higher return rate than the interest rate they're paying, then stockholders, their equity holders, will earn a higher return on their capital. And that's what's called leverage. So if I can borrow money at 5% and invest it in my company and earn 10% with it, then that difference between the 5% and the 10%, that 5% difference, all of that income that I generate will accrue to my stockholders, to my equity holders. So debt is generally cheaper than equity because debt carries somewhat less risk for the lender than equity carries for the investor. So debt becomes attractive to companies because they can increase their returns to their shareholders by using debt. The problem with debt, of course, is that it must be repaid, and when I have to repay debt, I have to make sure that I have the ability to repay. It's a legal requirement that I pay my debts. So when I borrow money, I have to pay it back, and that becomes a higher risk kind of form of capital than equity capital, which doesn't have to be paid back. So it's a trade-off between risk and reward. Long-term debt is less risky for the company than short-term debt, more risky for the lender, less risky for the company. So long-term debt is debt that doesn't have to be repaid currently. So it doesn't have to, the definition is it doesn't have to be repaid within a year, but long-term debt can be 2-year debt, or it can be 5-year debt, 10-year debt, 20-year debt, even 30-year debt. In fact, there's some corporations have issued long-term debt that was 100-year debt. So the railroads in the 1920s and 1920s, not so much the 30s, some railroads issued 100-year bonds. So the bonds did not have to be paid back for 100 years. They carried interest, so they had to pay the interest every year, but they didn't have to pay the principal back for 100 years. So that's pretty permanent capital, but not totally permanent. It still has to be paid back. It's still debt. So that can be whatever, length of term can be whatever the borrower is willing to lend for. So corporate long-term debt either comes from banks, sometimes insurance companies or other financial institutions, or companies can issue bonds, and we'll spend a fair amount of time talking about corporate bonds a little later. But bonds are sold on the market, in the marketplace. They are subject to SEC Securities and Exchange Commission rules and regulations, and they are tradable debt. So I can lend money to a company by buying a bond, and then I can sell that bond to my neighbor. I don't have to hold that bond. So in that sense, it's sort of like common stock. It's tradable after it's been sold. Bank debt is made by banks and generally gets paid back to the bank that made the loan. Generally, banks don't like to lend long term. Banks borrow short term, so they want to lend short term. So when you put a deposit in the bank is actually borrowing that money from you. That's what a savings account is, or a checking account. It's money you're entrusting to the bank or lending to the bank, and they don't want to lend out long term because your savings and checking accounts are short term borrowing. They have to pay it back whenever you ask for it. So banks are averse to long term debt. They will lend long term, but generally when they lend long term, they want security. So that's what a mortgage, a home mortgage, has security. It's secured by an asset, the house. So they don't generally do normal unsecured lending long term because they're not really set up to do that. So bonds, corporate bonds are a way to borrow long term for corporations, which is hard to do from financial institutions. I'm going to do this again. I did this the last time. Here we go. So what's a bond? Well, it's a formal debt instrument. So it's a contract, and it obligates the borrower to repay the principal, the amount borrowed, at a specified time in the future, which is called a maturity date. Most bonds pay interest twice a year or semi-annually. It's not required, but it's a convention. So most bonds are issued and pay interest to their holders twice a year. There are some bonds that pay on different schedules. There's certainly no legal requirement that be twice a year, but it is a common accepted practice that it be twice a year. So if I'm a company and I want to issue bonds, I have to file with the Securities and Exchange Commission saying I want to issue, I don't know, $100 million worth of 10-year bonds. And that's a registration statement. I have to provide all sorts of information to the SEC about what I'm doing, what interest I'm going to pay. It's a big, long process. And then those bonds are sold in a public market, just like stocks. So if you wanted to buy a bond as an individual, you could go online these days to a broker and like a Fidelity or a Vanguard or what are some of the other ones? E something, one of the internet brokers. Merrill Lynch, any of the big brokerage firms, and you could go to their website and you could find bonds and you could decide to buy a bond in a company. And that bond might be a new issue, and then you'd buy it directly from the company, or it might be a resale by somebody else who owns the bond who wants to sell it. So there's a market in bonds. And bonds can be have lots of different kinds of contractual pieces to them. And I'm going to just go through a few of the common contractual pieces of bonds. There are two kinds of bonds in terms of secured and unsecured. Secured bonds have specific assets that are pledged as collateral. So a secured bond says, you're going to lend me money and you have a security interest in my warehouse. So in the event that I was not to pay my bond, you could take control of my warehouse, an asset. So that's a secured bond. If there's a default, the lender's entitled to the assets pledged as collateral. Unsecured bonds are not backed by a specific asset. They're secured by what's called the full faith and credit of the borrower, which means that in the event that the bond isn't paid, you, like all the other creditors, are in line to get paid after the company liquidates their assets. So a secured bondholder, in the event that the company for instance, declares bankruptcy, a secured bondholder has a right to take the asset that it's securing their bond, whereas an unsecured bondholder has to wait for all of the assets that aren't secured to be liquidated, and then they will get their rateable share of whatever the company has left after they've liquidated their assets. So two different kinds of bonds. Obviously, secured bonds are more secure for the lender, and therefore they generally will carry a slightly lower interest rate than unsecured bonds, which have a higher risk, so therefore demand a higher interest rate. If you end up investing in bonds yourself, make sure you know whether you're buying a secured bond or an unsecured bond. As an example of what the difference can mean to the investor, when General Motors went through their bankruptcy in, I think it was 2009, they had some secured bonds and many, many unsecured bonds. And the security for the bonds that were secured were some of their assembly plants. And in the bankruptcy proceedings, the secured bondholders threatened to take the assembly plants, which that was their security. And if they had taken those assembly plants, General Motors would have had a great deal of difficulty in getting through bankruptcy and continuing to operate, and then coming out of bankruptcy and as a company that had the ability to operate. If they didn't have their assembly plants, it'd be pretty hard for them to operate. So those secured bondholders essentially said, pay us or we're going to take your assembly plants. And so in the bankruptcy proceedings, they were able to secure about 70 cents on the dollar that they were owed, 70% of what they were owed, whereas the unsecured bondholders got about 30 cents per dollar of what they were owed. So the secured bondholders came out much better than the unsecured bondholders. And in the General Motors case, the stockholders, the equity holders, got nothing because there weren't enough assets to pay the creditors, so the equity holders got zero. So secured and unsecured makes a difference, and generally that difference is reflected in the interest that they pay. So secured bondholders generally will get a lower interest rate because they have the security of assets. Another difference between bonds, there are callable bonds and non-callable bonds. Callable bonds give the borrower, the company, the right to redeem the bonds at any time or at some specific time, depends on how it's written, whereas non-callable bonds are not able to be paid back until the end of the term. So what that means is if you have a callable bond, if you issue a callable bond as a corporation, and let's say currently interest rates are 5%, so you have a 5% bond out there, and then interest rates fall, you can pay off the 5% bonds and reissue new bonds to new buyers at 3%. Pretty nice. If interest rates fall, you can call the bonds, pay them off, and then reissue new bonds at lower rates. If interest rates go up, obviously you're not going to call the bonds. You've got a bond that you're paying 5% on. Now interest rates are higher. You're not going to call the bonds. So it gives the borrower some flexibility. However, the lender, the person who's bought the bonds, if they've got a 5% bond and interest rates fall to 3%, they don't want that bond to be called. They would prefer to own a non-callable bond that the company can't pay back early. So the bond contracts can be either callable or non-callable. So if you end up being an investor in bonds, make sure you know whether you're buying a callable bond or a non-callable bond. It makes a difference. And once again, non-callable bonds usually carry slightly callable bonds will carry a higher interest rate, and non-callable bonds will carry a slightly lower interest rate. There are also registered bonds and coupon bonds, and this is becoming less and less of a factor as time goes on because there's been no new coupon bonds issued since the 1980s. Registered bond, all bonds that are sold now in the United States are registered bonds, which means that interest is paid by check and mailed to the bondholder whose name is registered, and guess what, their social security number is registered too, so the IRS is informed of the interest that you receive. Coupon bonds existed for decades, centuries probably, and they had beautiful pieces of paper with coupons attached, and there was a coupon for each interest payment. And the little picture on the right there is someone clipping the coupon. So folks who own bonds would go keep their bonds in a safe deposit box, and once a quarter or once every half year, they would go to the safe deposit box and they would, somebody's rapping somewhere, but I don't think they need to come in. They're just making noise. Excuse me. So coupon bonds you would go and clip off the coupon, take it to the bank teller, and the bank teller would give you the interest. There was no record of who the interest was paid to. Whoever held the bond, it was called a bearer bond, whoever held the bond owned the bond and the interest. And the bank would redeem these coupons with the company, but the company didn't know who they were paying. The bank didn't keep any records of who they were paying, and you got your interest payment. So when I was a young man, we didn't call people trust funders, people who had funds that sort of supported their lifestyle. We called them coupon clippers, because once a month or once every 6 months they would go to the bank and clip coupons, and that's what they lived on. They lived on the interest from their investments, from their bonds. There are still some coupon bonds out there. If the bond had a very long life, a 50-year life or a 75-year life or a 100-year life, there are still a few coupon bonds out there. But in general, almost all bonds these days are registered bonds. So this is just a summary. We talked about secured and unsecured. We talked about callable. We didn't talk about term and serial. Almost all bonds are term bonds, which means that you borrow the money and you pay it back at the end of the term. So if it's a 10-year bond, you borrow the money, you don't pay any principal back until 10 years out. A serial bond is one that requires a partial payment of principal every year. There aren't very many of those out there. There are a few, but they're rather unusual. So most bonds are term bonds. We talked about callable, non-callable. Some bonds are also convertible, which means that they're sold with the option to converting them to common stock at a fixed price, usually a price above where the price of the common stock is when the bond is issued. But what that does is it gives the bondholder the right to participate in the company's future success, if they have future success, by converting their bond, which is a fixed income investment, to stock, which is an equity investment that has the potential to grow if the company grows. And we talked about registered and bearer bonds. So there's a bunch of different kinds of bonds there. People struggle with bonds pricing. And bond pricing has much to do with the interest rate that the bond has on its face relative to the interest rate that the market is paying for similar bonds. So this example here, Castine Investment issues $100,000 of 7% bonds when other bonds of similar risk and maturity are paying 8%. So they're paying less than the market rate. So therefore their bonds aren't as attractive as bonds paying the higher rate. So what will have to happen is the bonds will get sold at less than face value. It's called issuing bonds at a discount. So the issue price in this case, I've done the math on this one, the issue price would be $93,205 for a $100,000 face value bond at 7% interest, which takes into account the 1% difference between what we're paying, 7%, and what the market is offering, 8%. That's a bond issued at a discount. The company will have to pay back. They will receive $93,000 at the end of, let's say this is a 10-year bond. I think that's how I calculated it. They will have to pay back $100,000 at the end of 10 years. So the bond owner will get a lower interest rate, but they will also get a capital gain at the end. They'll get $7,000 additional above what they lent at the end. So that's a bond issued at a discount. Flip side, the same Castine Investments, they issue 7% 10-year bonds when other bonds of similar risk and maturity are only paying 6%. So now they're paying higher than market interest rate. So therefore, investors will be willing to pay more than $100,000 for these bonds because they can earn 1% more than the market. They're more attractive, so they'll actually pay a premium. They'll pay $107,000 for a $100,000 face. The company will get $107,000. They'll pay $7,000 a year in interest for 10 years, and then they'll have to pay back the $100,000 at the end. There's mathematics to calculate those premiums and discounts, and in each case that I've showed you, the buyer will receive the market rate of interest. So in this case that we're looking at here, they'll pay more than face value for the bond, but over the 10 years they will receive a 6% per annum interest rate. Why am I telling you this? Well, companies almost never sell their bonds at face value because they have to go through the SEC approval process, and when they do that, they set the interest rate that they're going to sell the bond at, but then when they go to market, the interest rate may be different 6 months later. So they usually sell their bonds at either discounts or premiums, and you will, if you look closely at financial statements, you'll see the difference. You'll see that it's disclosed in the notes to the financial statements. So just realize that companies almost never sell their bonds at the face number. They sell them at a premium or a discount to the face number. Bonds can be traded individually. Once you own a bond, you can sell it to somebody else. So if I buy bonds in IBM, I can sell it to you. Later, I can own it for 2 years, and then it might be a 10-year bond, and you would buy an aftermarket bond from me. It's still going to pay you interest, and we'll transfer ownership, and you'll get the interest checks instead of me getting the interest checks. The bond market changes, prices of bonds change based on interest and also whether the company has risk profile has changed. Higher market interest rates cause bond prices to fall for the same reason that we talked about bonds being issued at a discount. If the market rate goes up, my bond is a fixed income security. It's going to continue to pay the same amount of interest, so people will be less willing to pay for it. They'll be willing to pay less for it because the market is selling at a higher interest rate. So market interest rates have risen. So when market interest rates go up, bonds fall. When market interest rates fall, bond prices rise. So the bond prices, the price someone's willing to pay for an aftermarket bond, moves in the opposite direction of interest rates. Higher interest, lower bond prices. Lower interest, higher bond prices. So that's something to understand about that. When companies issue bonds and pay interest, the payments on the interest are tax deductible. So that reduces the effective cost of debt to the organization. So when I issue stock and then pay dividends, dividends are not tax deductible for the corporation. If I issue bonds and pay interest, interest is tax deductible for the corporation. So that's going to change the after-tax cost or reduce the after-tax cost of interest payments. So interest is actually tax favored. So that makes my net cost lower when I borrow money as opposed to raise it from equity and pay dividends. So just interesting thing, and currently there's been lots of talk about tax changes in Washington, and one of the initial tax changes that they talked about that it seems to have been dropped now was to eliminate the deductibility of interest payments for corporations. That would have changed the landscape quite a bit. Borrowing would have become less attractive for corporations than it is currently. They would have looked for more equity and less borrowing. It probably would have changed mix that most corporations want on their balance sheets because borrowing would have become less attractive. So I think that provision has now been dropped from the proposals, but who knows what will happen. I thought it was a pretty interesting provision because I see throughout our tax structure that we incentivize borrowing. We incentivize it for individuals as well. So we incentivize borrowing for a house because the interest on borrowing for a house is tax deductible. Mortgage interest is tax deductible. That incentivizes people to use debt for their housing, and it makes the debt cheaper because some of the interest we can not pay tax on, so that reduces our tax bill and our net interest cost is lower. So the tax code really encourages debt, and maybe we have a little too much debt in the economy. So I would think it would be good to change, but that's just me. I don't have any political influence, so I'm not sure that my ideas will go any further than this lecture. Let's see, we've done. Well, let's go through preferred stock as well, and then we'll stop at that point. So preferred stock, another kind of stock. It's a hybrid. It's halfway between debt and equity. It has some characteristics of both. It shows up in the equity portion of the balance sheet because preferred stock does not have the investment never has to be paid back. So it's like equity in that sense, but preferred stockholders don't actually have an ownership interest in the company. They don't get to vote for the board of directors, and their stock value won't change based on the performance of the company because preferred stockholders get a fixed dividend. They get a dividend that does not change, and in the event of liquidation, they get what they paid for their preferred stock back and nothing more than that. So they don't own a share of the company, but they're kind of like equity and kind of like debt. Accountants treat them as equity because we don't have a requirement to pay them back, and we actually don't have a requirement to pay their dividends, though there are other requirements around dividends that we'll talk about in a second. And dividends on preferred stock are not tax deductible, so they're just like dividends on common stock. So why would you choose to issue preferred stock if the payments aren't deductible? Well, it's patient capital as opposed to capital that has to be paid back. So it's attractive to the corporation to have preferred stockholders. And not many corporations don't, they just have common stock. But it's certainly an option. And it's attractive because it allows the corporation to increase their equity holding, which essentially reduces leverage and reduces risk because they don't have to pay this back. So the preferred comes from, I don't think I have a slide on that, but the preferred comes from a couple of preferences. So the preferences on preferred stock are that they get their payment of dividends before common stockholders can be paid any dividends. So if the preference on dividends is preferred stockholders get their fixed dividend, let's say 5% preferred, they'd get a 5% dividend on their face value of their stock, so the $100 par value of their stock. So they get a $5 dividend every year. If the company pays dividends, they have to pay all of the preferred stock dividends before they pay anyone else. So that's a preference. And the second preference they have is in the event that the company liquidates, preferred stockholders get their par value back, the amount that they invested. My example of $100 par value stock, they would get their $100 back before common stockholders got anything. So they come after debt holders in liquidation. Debt holders get paid first. If there's any liquidity left, any assets left after that, then preferred stockholders get paid. And then finally, if there's anything left after that, common stockholders get paid. So they're ahead of common stockholders in liquidation. So those are the preferences. There are a couple of different kinds of stock. Cumulative preferred if a company, a cumulative preferred stock says, if they don't pay me dividends this year, because they're not paying dividends, and they don't pay me next year, the third year they declare dividends, they have to pay my accumulated dividends, the 3 years of dividends, before they can pay common stockholders anything. Non-cumulative preferred, if they don't pay any dividends this year, you're never going to get them. So two different kinds of preferred stock. And then, like bonds, there are also convertible preferred or preferred stocks that can be converted into common stocks at a fixed price. So that would be from an investor standpoint, I get a fixed dividend, but if the company does really well, I can convert my stocks into common stock and become a regular stockholder as the company and participate in the growth of the company. Because preferred stockholders don't get to participate in the growth. They have a fixed investment, a fixed maturity, a fixed income investment. Okay, so let's stop there. A few questions, and then we do have a third part of this chapter 5. It's a pretty long chapter, a lot of stuff in it. So we will stop here, and then we will go forward into the rest of chapter 5 after you've answered some questions. Thanks.